There it goes.
Perfect. So first up in your agenda is the capital project financial plan for the mail order pharmacy. We discussed this yesterday. We also discussed it at HSB. So both in HSB and Buildings and Grounds. As you know, the Buildings and Grounds Committee determines whether a project should be added to the major capital plan, and the Finance Committee determines whether there is a sound financial plan. As you know, specialty and mail pharmacy services have grown significantly and have reached capacity in the space that they're currently leased in. There is sufficient funds for the project. I'm happy to answer any questions if there are any.
Mr. Chairman, I'll ask the same question I asked yesterday about the other project. What is the financial plan for this model? Is it going to be a revenue-producing model? And if so, how much and how quickly?
Yeah, so this will be accretive day one. I mean, this is growth in the pharmacy initiative is obviously a key revenue enhancer for UVA Health.
What projections do you have in terms of actual dollar values that it will generate and how quickly?
So I have annual spreadsheets because I have to, it's so accretive, we have to pay unrelated business income tax on it. So the pharmacy programs makes millions of dollars each year for UVA Health.
This will make us make millions more than millions.
Incrementally, yes, it will allow us to expand operations.
Thank you.
Other questions? Is there anything else you wanted to say on that?
No, I'm good.
Other questions? Any comments? Hearing none, there's a resolution on page 1 of the Finance Committee book. Is there a motion to approve it?
So moved.
A motion, is there a second?
Second.
All in favor, please say aye.
Aye.
Any opposed? Thank you.
Great. Next up, as you can see, that we have a item for your approval today, which is the Virginia Guesthouse. As you've been able to observe it as you're driving down Ivy Road, it is nearing completion. We are slated to open this facility in late 2025, and this facility will be approximately 223,000 square feet with 214 rooms and 28,000 square feet of conference space. The Guesthouse will offer a variety of dining options. As you know, we have discussed previously, it is our belief that this is not one of our core competencies, and as such, we're recommending the University of Virginia Foundation oversee the Virginia Guesthouse management and operations. We have spent a considerable amount of time of this project and this initiative with the UVAF Foundation. As a result, we are recommending that we enter into a ground lease with a taxable subsidiary of UVAF called VGH of Charlottesville and transferring ownership of the vertical improvements. Again, we will continue to own the land, but the ownership of the vertical improvements will revert back to the university upon the expiration. This obviously has significant taxable benefits, plus it will allow them to oversee that initiative on a daily basis. I'm happy to answer any questions. This is pretty standard of what we do.
Who funds the losses or gets the gains of this
The
facility?
UVAF, and we have a joint arrangement with UVAF. If profits over a certain point, they come back to the university. Remember, UVAF is a 501c3, but it serves for the mutual benefit of UVA.
Can I assume we're getting economies of scale now with all our hospitality?
Absolutely, absolutely. And we can talk about this at any point. UVAF is experienced. As you know, they own and operate the Boar's Head, and they've done substantial work in order to drive costs down in the back offices. So things like housekeeping, dining, sales and marketing, there will be major synergies here. We've also offered the same opportunity and explored it fairly heavily with Durden. Because they have their facility as well. So yes, it is definitely more efficient and effective to put this with them.
Other questions? Hearing none, there is a motion on pages 2 to 4 of the Finance Committee book. Is there, or resolution, is there a motion to approve the resolution?
So moved.
Motion, treat that as a second. All in favor, please say aye.
Aye.
Aye. Any opposed? All right.
Great. So the next, I believe, are a fairly set of routine requests, but as you know, the Board of Visitors is currently required to approve the execution of any contract where the amount per year is in excess of $5 million. These three contracts on this slide exceed, or we expect them to exceed, $5 million this year, and therefore they exceed my individual authority. Just to be very high level, the Ernst & Young is for the strategic accounting and consulting work that we are underway with to clear out the material weakness at UVA Health. We have delegated authority for a care benefits provider because we are looking to be more efficient and effective in child care services. This is outsourced to a third party, as well as to provide backup care for emergency situations. And third, we would like you to delegate authority for our system implementation firm, and this is obviously to move towards a pan-university system integration between the academic and the med center and UPG and community health. So we are seeking your approval on page 5. Happy to answer any questions. We've discussed all of these previously.
Mr. Chair, how much have we spent on Ernst & Young over the last 3 years for consulting?
Yeah, so great question. So in fiscal year 24, we spent approximately $3.7 million, and this year we expect to tip over $5 million to complete the remediation.
Other questions? There's a resolution on page 5 of the Finance Committee book. Is there a motion to approve the resolution? We have a motion and a second. All in favor, please say aye.
Aye.
Any opposed? One more contract.
Great. So as we stated earlier, you are required to approve contracts in excess of $5 million. The first contract listed here under the medical center is for Care Fusion Solutions, which is to remediate and refresh our IV pump systems. The contract's annual spend is approximately $5.4 million. And the second contract is to improve the medical center's imaging technology. It will be a combination of equipment and upfits and replacement for UVA Med Center's radiology. Both of these exceed my authority to approve. So no questions?
Quick question, just out of curiosity, are those, Wendy, you might know, are those those imaging equipment in the hospital, or are they the or UVI or some combination?
In the inpatient.
Okay. Thank you.
Other questions? There's a resolution on page 6 of the Finance Committee book. Is there a motion to approve the resolution?
So moved.
There's a motion. Is there a second?
Second.
All in favor, please say aye. Any opposed? All right, turning to the data center.
Great, great. So today I want to present the BOV, a longstanding discussion and an important initiative for UVA, and that is the University Data Center. With me today is Kelly Doney, our Vice President and Chief Information Officer, and Josh Baller, our Associate VP for Research Computing. There is no decision for today. This is an effort to have a robust conversation about sort of the initiative, why we think it is critical, and to take any questions, comments, or concerns between the meetings so that we hope we can seek your approval at the June board meeting. So without further ado, Kelly, Josh.
Great, thank you. Good morning, everybody. Slide, there we go. All right, so the bottom line up front here is that we have our current data center at near maximum capacity. The unfortunate news is that we really are limited in our ability to expand, both in terms of the physical location, as well as the cooling and the power limitations that are with that current facility. And really what we're looking at right now is we say we're at max capacity. We can already see that our researchers are experiencing significant delays in their ability to access the computational resources. And this is a big factor in terms of faculty recruiting and that retention. And we want to be competitive with other schools when we're looking for those top-notch faculty to bring here to UVA. That facility currently serves a wide variety of researchers spanning multiple disciplines. We were just looking at some data. In fact, since the beginning of the year, our top 2 users are out of a college. But we certainly have people from the School of Data Science, the National Security Data and Policy Institutes, the Biocomplexity Institute, in medical, engineering. We've got a fair amount of widespread usage there. And we've listed a couple or three here, computationally focused awards that we've recently secured. But really, I think one of the important messages here is that in all fields of research, we're really seeing things move more toward data-driven activity, which puts even more emphasis on the importance of this facility for our research activities. So the new site it has been identified in the Fontaine Research Park. It is conveniently located adjacent to the Fontaine Energy Plant, which is fantastic for us because that really enables some great efficiencies through geothermal heating and cooling, and we're able to share back the excess heat generated through that data center for other needs on grounds. The estimate is for $72 million build. We're going to start with a 4 megawatt facility, but expandable out to 16 megawatts as our research needs grow. We really need to start this construction by I guess, 2026. We were talking 2025. I think we can make it to 2026, but we need to be online by early 2029 in order to support the needed upgrades to keep pace with the research needs. So we have done an extensive analysis to look at what are our options here. And really when we break it down and we look at the difference between building our own data center here on grounds versus a co-location facility or a cloud-hosted type of arrangement, the most cost-effective way to do this is going to be clearly to build our own data center. Dr. Josh Ballard is here today to talk a little bit about that analysis that we've done and show you the cost models that we've generated looking at these different options.
Thanks, Kelly. So one of the first things we looked at was a co-location facility or colo facility. This is effectively leasing a shell from another large-scale provider. Starts out empty. We are responsible, first of all, for building out that shell in coordination with the partner that we're working with. And then we pay leasing, pass-through power, and other costs associated with that with operating the data center in that space. What I've included here is a chart of the cumulative costs we expect between colo and an on-premise site over the next 20 years, the blue being the colo facility. What we see is that as the data center ramps up, this gets substantially more expensive through the colo facility. On top of that, this is a leased facility that has a renewal. And due to the high upfront capital cost of setting up this facility as well, along with the fact that we will then install relatively expensive HPC hardware in a facility like this, we're sort of a captive audience. If the lease renewal comes up, we sacrifice, first of all of that investment in the facility that we made, plus the hardware that is in here is extremely heavy, it's extremely fragile. Moving this hardware to another location, especially to try to coincide with a lease renewal, will be difficult. We may lose some of that investment as well, which makes this has a degree of risk to it that is also unappetizing along with the cost. Next one there. Another question that comes up a lot, and we try to make sure we address this because cloud plays a very important role in our sort of hybrid strategy for research computing, but it doesn't fundamentally meet the primary workloads that we need. It is not a responsible solution for this. The reason for that really comes down to how research HPC operates. We see essentially continuous workloads on our system. I actually just pulled up some data from last weekend. We saw that on Friday afternoon, there were about 15,000 jobs waiting to run on our system. By the time we got to Monday morning, that had come down to about 5,000 jobs. So during that entire time, the system is running at capacity. The way that cloud is priced really incentivizes you to use it for cases where you need burst. Things like you might see sort of in a corporate workload where you have a surge in the middle of the day and you need to make sure you can scale to that particular need. We don't tend to see that, or when we see it, that's on top of the core resource that we need to provide. And so we then look at the cost of cloud if we were to move in this direction. I'm just showing a GPU comparison here, which is used for a lot of the AI and other image analysis workloads, other things we see as an emerging research area. And we see that on a apples to apples comparison between the orange line on the top and the gray line on the bottom, there's a 5 times difference on the annual cost of this hardware to do it in the cloud versus do it on premise. We also wanted to look at, this is hardware that's like the Cadillac model. We wanted to look at something that's 1 generation older. It's not our preference to go with that, but there was a concern that maybe the pricing in the cloud was just extra high for that special hardware. So the blue line represents taking 1 step back to older hardware, and we still see multiples of our cost in operating in the cloud. Doing this at scale would be extremely expensive. And just to kind of reiterate what Kelly started with, this has become core research infrastructure for many researchers. More and more fields of inquiry are becoming data intensive. We expect that to continue to expand, even sort of with our current rate of research. And so not having capacity to meet the current need, and as I talked about, we already see 15,000 jobs on a Friday, only down to 5,000 on a Monday, without people necessarily working all weekend long. If we don't continue to keep pace with where the rest of the community is at nationally, we are going to be at a competitive disadvantage. And this means that we will be at risk of losing faculty as they get offers from other universities with more resources. And we will have trouble recruiting people that don't believe they can do their research here at UVA.
Anyone have questions? David?
I do. I have a few. Hoping our finance chair will weigh in because I think he knows something about data centers. But first of all, when DeepSeek came out, the scare I heard amongst the data center community was, wow, it's so efficient. That's just one little thing, but there could be greater innovation, which greatly reduces the power requirements or so forth. So the innovation piece of this, could it change the landscape so much that we become antiquated? And do we need to worry about building the wrong thing and then being outdated? Second of all, I don't think there's any question we need something like this. So what do we do in the meantime if we can't get stuff done? Is there a temporary fix? And then thirdly, on the power side, other than SMRs, I keep hearing about various little, sort of more micro power sources coming out and innovation there. And I'm curious if there is anything on the horizon that might be relevant to this discussion.
Yeah, so starting with kind of the DeepSeek question, I'd say first of all, we have a breadth of technologies or algorithms that people are using on our system. And definitely large language models, DeepSeek being one of them, is an emerging area, growing area. It still isn't the majority area, and it'll definitely grow, but I don't foresee it being what everyone does on the system. There's a lot of other image processing related things that are of also really strong interest. That's even on top of that though, so DeepSeek was about a 10 times reduction in power and computing capacity. For us, that is the amount of compute and power capacity needed for that is just mind-boggling to begin with. And I'm actually excited by cuts like that in terms of what's required, because if we think about someone right now can barely operate with one of these models, as that complexity goes down, we can start to use these in things like agent-based modeling, where people have thousands of these running simultaneously, each representing a consumer and an economic model. And so it really just opens up the potential for more research that our faculty could be engaged in, rather than negating the need for this in the long term. And then the power one, I apologize, I didn't ask.
If you can add anything to this.
Yeah. Well, you mentioned small modular nuclear reactors, which we're investigating along with a number of others in the space. But I don't think anyone thinks it's realistic that you're going to have a operating small modular reactor until the middle of the next decade. It is very difficult to see where a dedicated solution for a data center of this size, which is small, compared to what our requests are, that you could find an off-grid system that is going to be anywhere near as cheap as being on the grid. It's just a scale issue. So it doesn't strike me, and we're obviously happy to serve the load from this particular data center, and maybe I need to
Discount?
recuse myself from any vote on it, but it is difficult for me to see how there would be an off-grid solution that would be more cost-effective for this data center than being on the extraordinarily efficient and inexpensive Dominion grid.
Fair enough.
Great. Any other questions?
Are there other questions? JJ said we're not asking for action here today, but wanted to make sure there was plenty of opportunity for people to have a chance to talk about it, since we will have a few other items on the agenda at the next Finance Committee meeting as well.
I can't resist one question, which is just, I'm trying to picture in my mind's eye, when you say like a job or data intensive research, like I'm trying to picture exactly what that means as someone who has no research experience.
You're right, I jumped to the jargon.
Just like, what is, you know, you've got the professors and I guess engineering and medicine and what is it that their computers are doing? Just like big data sets? Is that the issue? Like, and
Yeah.
the right, just what I think of as a computer can't handle that, so it's got to go somewhere special. And could you just give us a paragraph on that? What you mean by a job and what is the activity that's occurring all weekend for 15,000 different events?
And so I'll also add, I'm happy to discuss this offline, given that we have limited time here.
Right.
I can talk for hours. But the
Just
short
give me the
answer-
4-sentence version. That's all we really have time for around here.
Yeah. The primary way our supercomputers work is what's called batch, meaning people can submit work saying, I want this to run when there's room available, and it gets scheduled and finds a spot and it runs. So I use job, I mean one piece of work that someone has submitted. And so sometimes this might be an individual submitting 1,000 pieces of work, which might be, I have 1,000 images, I want AI to go in and segment this medical image into, this is cancer, this is not cancer. It could be that we have people in astronomy that are using this to analyze, all sorts of data about imagery that they've selected there.
Milky Way, yeah.
It could be that we have computational chemists that are at the molecular level trying to model how chemical reactions occur. And they're trying to simulate every little bit of what's going on, where the electrons are, where the waters are, and are trying to build a simulation of this and run that through a fraction of a second. And so each one of these things will be submitted as a piece of work on there. And then on top of that, we are increasingly using these for interactive work, where instead of someone frankly buying a system in their lab, they can log into our system remotely and use this interactively in a way that addresses some of our security concerns in other ways.
Felt very helpful, thank you.
Can I ask one question? Will we be doing DoD work here?
We already do DoD work in this space. We operate a CUI compliance system that is here. It's part of the existing system. It'll be continue to be built out as we see more demands. And that also, there's another, so that's controlled unclassified information, as well as there's CMMC, which is a new set of regulations that we'll be looking to address.
So would DoD even allow us to co-locate?
Most of the facilities any facility we would look at would be FedRAMP and other types of compliant, which means that, yes, we can do the majority of the work any work we are doing currently in our data center, I expect we'd be able to do in a colo facility.
Mr. Chairman,
Yes.
could I go back to David's question about the interim between now, you say we're already challenged, and 2029 when new plant comes on? Is there a plan, or what do we do in that 4-year period?
So I have sort of my roadmap for when we're building out new equipment, what we're installing, how we're meeting the demand that's there. And the reason the 2029 date is what it is that I kind of look at the curve of what I can do, extraordinary measures, if you will, to get us to 2029. And I think we're good through that time period. But I have some concerns about delay beyond that, because primarily what's coming up is we purchase major hardware every 5 years. Our hardware will need to be retired around that time period. And it'll be past retirement age even at that point, to be frank. And so as I push farther out, we have the risk of hardware failures that we won't be able to repair. And so we would see a sudden reduction in the amount of computational services we can provide on grounds. And we can patch that with things like the cloud. So we have planning, is what I would like to say. but there's a high cost to those intermediate solutions if we have to go that route.
We also have just a tiny bit of room in our current data center that allows us to do a little bit of tweaking between now and then as well.
Yes. So that's part of that roadmap for the next couple of years here.
And when the new system comes on in '29, do we keep the old one, or how does that?
So I generally operate 2 systems at a time on like an 8-year time frame total. So the second one, the older one, will be getting fairly old. It'll last maybe another 2 years. We will continue to operate it up until it's no longer worth the money of operating it effectively. Then that will shut down and the replacement would go into the new data center.
Thank you.
Other questions?
I just want to say thanks to both of you. This is an incredibly important project, and it is obviously in super capable hands, so thank you.
Great, thanks very much.
Okay, so next is a very brief update on the General Assembly. As you know, we did get on February 22nd, the General Assembly adjourned and House and Senate and then budget conference reports. We are still awaiting the final decisions of the governor. As you know, the governor can do line item vetoes, so what we will share with you is still preliminary. And then April 2nd will then be the reconvened session. So important to note because all of this information will ultimately flow into the building of the 26 operating and capital budget. So specifically, some great news. The governor did include and the House and Senate supported the expansion of the Commonwealth Bioaccelerator. There was a very large event last week on that. That is designated for Up at North Fork Research Park. It is a public-private partnership between UVA, local nonprofit, Seville BioHub, and the state, aimed to support the growth of early-stage life sciences companies by providing resources, infrastructure, and mentorship. So this is really, really critical and obviously part and parcel with the Manning Biotechnology Institute. There is some resources for tech talent. As we know, we have an agreement with the Commonwealth in terms of degrees that we're expanding. A little bit of money for undergrad financial aid and money for maintaining access and affordability. That is about the only operating money in the budget. So we are challenged with health insurance, operating new buildings coming online, and really no new O&M funds. In addition to that, there's some incremental funds in enrollment attention and then maintaining access and affordability. Again, incremental funding of about $212,000 for fiscal year 26. So one of the things I want to bring to your attention today, and don't have solutions, but something for significant conversation, is that the budget includes a fairly generous pay package. And what I mean by that is 3% merit-based plus 1.5% bonus. That in just raw numbers is about $40 million just for the base, and then about another 16 to 18 million for the bonus. Typically, the way it is funded is the Commonwealth funds about 16 cents on the dollar, and the rest is to be made up by the university. Most notably, the largest lever is tuition, both for in-state and out-of-state. That has historically been and approved by the members of the General Assembly. So this is obviously a fairly sizable cost driver in the 26 budget that we are grappling with as we speak. And I'll spend some more time in the back section today really talking about sort of the macro financial levers and would love any guidance, discussion about that as we get to it. In addition to that, as you know, we talked extensively last year about the Virginia Military Survivors Independence Education Program, incredible program. Unfortunately, it has been underfunded, and so it has become a significant cost driver, not just to us, but the College of Wise. And so there is some additional incremental funding, but it is not sufficient to cover the true cost. So it is still an unfunded mandate from the Commonwealth that we're working through. That'll also be a discussion as we build the 26 budget. On the capital side, as discussed yesterday, great news. We do see funding for full construction of the arts project in the capital pool. Obviously, still awaiting the governor's final budget, but that is tremendously good news. And obviously, Colette and I think Chairman at B&G yesterday. John now talked about bringing that back in June for a robust discussion. And then there are some items in the capital budget for College at Wise, basically $250,000 for pre-planning and the technology classroom building project. And I believe Chancellor Henry will speak to that later. Yes.
I think that's great news on the funding for the arts building for June. Would we be able to get any sort of rough idea of the operating budget?
Yes, our expectation is that we'll bring back not just the redesigns of the capital, but also operating model. We're working with the provost office on that matter and a large team. So yes, is the short answer.
That's a quick question.
Yes.
JJ, on the raises and bonuses.
Yeah.
Is that like by law you shall give these raises and these bonuses, or is we authorize you to do so, or what is the exact economic dynamics of that?
Yeah,
I'm
it's a
just
great
curious.
question. So it is not required, however, it is strongly encouraged. And so
Well, for some portion of our employees.
I'm sorry, that's a great point. So for classified staff that remain in the state system, it is required.
Okay.
The challenge for us is that we went back and looked the past 20 years. We have always followed the governor's ultimate and General Assembly's budget, in part because there is funding tied to that, and you will sacrifice. You have to certify.
16 cents on the dollar.
Yes.
You're talking about? Okay.
Yeah, so you have to certify that. And the second is that I think it will be a detractor in terms of our ability to recruit and retain talent. As you know, it's cost of living is going up. There are obviously parking, health insurance costs also that are likely to increase this year. So I think what we don't want to find ourselves, particularly in working with the board about recruiting and retaining our most prominent faculty, finding ourselves unable to do it. Having said that, the resources in the budget probably dictate then more budget cuts in order to redistribute. So again, we'll talk at length about that.
I understand. I just wanted to make, you'd mentioned something about that to me before. I just want to make sure I understood it now.
Yeah, we went
now
back.
I do. Thanks.
Yeah, and we
Yep.
went back 20 years and we've never deviated. So, and we have flexibility
Do we
on.
know whether any other universities have?
I am not aware of anyone deviating.
No, I'm not suggesting we deviate.
Right,
I was
I know,
just
yeah.
curious
Yeah.
what the dynamic was
Yeah,
exactly.
exactly.
Now, I think I understand now.
Okay.
Is it 3% to everybody, or is it
No.
is it going to be 5% and 1%?
Correct.
Does it
It's
just have to average?
merit-based, so it has to be based on a complete evaluation of someone's performance. So you can get more or less based on performance. But the pool in aggregate across the institution should be 3%.
Would you remind the board of the last 3 years on the percentage increases we've been asked to implement, and then what the total dollar amount of that is?
Yeah, great question. So,
And also, how much of that is funded by the state and how much of that is self-funded?
yeah, great question. So, as you know, if you go all the way back to 2021, 2022, we did significant pay freezes, base budget cuts, and we froze any compensation increases. Coming out of COVID, there was fairly meaningful raises that were put in place. It was a 5%, at 5%, and then last year a 7%. So it was 5%, and then the General Assembly added 2%. The overall cost to the system, and this is just in the academic, does not include the health system, was approximately $250 million of base new expenses. So this is real and tangible, particularly as we have constrained the tuition lever, because as I said, tuition is a primary lever that we utilize to balance out the university's costs in order to support these raises.
And JJ, how much was that funded by us and how much was funded by the state?
Oh yeah, it's still 16 cents on the dollar and everything else comes from us. So 84 cents on the dollar comes from UVA.
So 84% of the 250 came from us?
Yes.
Okay, thank you.
Okay.
Other questions?
Oh,
Sorry. A quick question. Just thinking about the environment we're in, if, federal research support is drastically cut or even partially cut, that has to impact our bottom line in a substantial way, I imagine. How will that play with this, do you think?
yeah, I think it's another constraint. So when we talk about it later on the macrofinancial outlook, one of the questions is not all the funds, resources come from tuition. They also come from grants and contracts. And so, will grants and contracts have the ability to pay their proportional share or not? It's a great question, Michael, and for one we don't yet have an answer, but all part of the analysis as we build the 26 budget. Good. Okay. So a couple of things, just really exciting news. The General Assembly report, first and foremost, incredible recognition of Colette Sheehy, Senator Deeds, Delegate Coulson, and Delegate Lawfer. You can see the photographs here. She was recognized on the floor with a presentation on February 18th for 43 years of dedicated service to UVA. There will be plenty of time to celebrate, roast, and toast her, but the resolution expressed the General Assembly's admiration and gratitude for her incredible commitment and leadership. And please note, one of her key roles is not just SVP. She also does an enormous amount of work coordinating across institutions of higher ed in the business officers and the financial people. So it was really incredibly well-deserved and fun day. Next, obviously, Senator Deeds and Delegate Lawfer introduced identical resolutions commending Dick Howard. Many of you know Dick. Howard is currently UVA's longest-serving professor, teaching from 1964 to 2024. And then there was also a commending resolution for Tony Bennett. So amazingly good, positive news coming out of Richmond, and so wonderful when UVA can be recognized for some of our amazing faculty and staff. So with that, if there are no questions on that, I'd like to turn it over to Robert Durden. This is your biannual endowment report update. Oh, there you go. Cool, thanks.
Hi everyone, pleasure to be here as always. Good to see you. Quick overview on UVMCO, and we'll talk about performance, team, positioning, recent investment committee actions, and hopefully give you a good 15-minute update on UVMCO. As a reminder, our core mission is to be the best possible financial partner to UVA. That 90% of the time takes the form of generating great returns and being responsible stewards of the endowment, but it takes other forms as well, and we work closely with JJ's and Augie's offices to do that. Only good is our people. We have an 11-person board. It's a fantastic board of directors. The latest addition, as I updated you in September, is Ted Weschler. He joined our board in July. As you all know, I think he is critical to the success, recent success of Berkshire Hathaway, and has been a great addition to our board. Our board members tend to serve 3 consecutive 3-year terms, with the exception of JJ, who is appointed by President Ryan to be on our board. Well tenured and good continuity in our team as well. Most of these folks have been with UVMCO for at least 5, 7+ years. Christina in excess of 20. I'm now in my 7th year at UVMCO. We are recruiting and have been recruiting since I last met with you in September for an MD focused on liquid equities. We've had 400 applications. Christina has interviewed 100 people initially, and then you've had a waterfall down to where we've had 10 into our office. I think we're getting close to a hire. Should have more news on that in the next week, but I'm excited to add someone on our team. Liquid equities is a kind of point of emphasis for our team right now, and it'd be nice to have a new senior person. Assets under management, a little under $15 billion. Last year, the long-term pool for the calendar year 2024 was up 10%, so generating just under $1.4 billion of investment gains. We distributed a little south of $500 million of that to various shareholders, including UVA, obviously, and netting out to about $14.6 billion at the end of the calendar year. It's a little closer to $15 billion today, or at least as of the end of February. We've had a difficult start to the market month in March, but think of the endowment as about $15 billion. Our primary objective is to maximize long-term real returns commensurate with UVA's risk tolerance, as you all know. This is something that we reaffirm every year in March. In fact, our board is meeting next week in New York to talk through the various components of our investment policy statement. That investment policy statement is generated to meet this primary objective. UVA needs to earn something like a 7.75% return to maintain the purchasing power of the endowment. That covers inflation, its spending rate, as well as any fees associated with the endowment. To do that, we set a risk policy that has, over the last few years, been 75-25 equities fixed income. We anticipate that that will be the risk policy for 2026 as well. We choose a passive policy because it is implementable, it's very easily understood. If UVA decided to disband UVMCO entirely, they could invest in a 75-25 policy portfolio with ease. So we think that that's important. But we do not think that that policy is sufficient to earn that nearly 8% return that UVA needs. So that is why we invest in a way that's very different from this passive policy portfolio. We invest across 10 strategies, 6 of which are predominantly private strategies, so leveraged buyout, venture capital, growth equity, private resources, private real estate, to generate at least 200 basis points in excess of about a 6% expected policy return to meet our goals. There's a slide later in the deck that shows that actually the passive policy has done a fantastic job over the last 20 years. If you look at it's compounded such that $1 is in excess of $4 today. But that's actually not enough. UVA needs more than that. That represents a 7% compounded return for the passive policy. So we invest differently than our passive policy so as to generate excess returns. Historically, we've done a good job of that. We'll turn to performance here in a second, but it's been an interesting last 3 years, largely with the equity markets driven by mega cap tech. That is coming off a little bit calendar year to date, but if you look over certainly the last 2 years, the market narrative has been dominated by the Magnificent Seven, materially outperforming an equal weighted S&P or an equal weighted ACWI index. The U.S. has significantly outperformed the rest of the world, including emerging markets and other developed markets. And if you look in the bottom right, it's been a very difficult forecasting period for economic growth or calls for a recession. There have been multiple calls for a recession in response to the Fed's aggressive rate hikes in 2022 that we have not seen. So it's just been a very volatile and narrow last 2 years in the markets. Against that backdrop, on 1 year, I told you the long-term pool was up 10%. Our policy was up 13.6. I think more interestingly, over 3 years, it's been a difficult environment, although we were recently, within the U.S. anyway, at all-time highs within the public indices. So you can see the policy up 3.9, long-term pool up 1.6. So why were we underperforming our policy? 2 core reasons. One, our liquid equities strategies, which are comprised of long biased public equity and long short, we tend to build bottoms up. We find active managers who are seeking to beat their relevant benchmarks. We tend to think that those managers have a better chance of doing that within small caps, emerging markets, areas of the market where folks are not spending as much time doing fundamental analysis. So we tend to have less exposure to mega and large cap companies than the index would have. That has been a headwind to our performance over the last few years. More importantly, though, we invest in private strategies. About 45% of the long-term pool is invested in those 6 private strategies that I mentioned earlier. You tend to get valuations for those strategies 4 times per year instead of every minute of the day, or the trading day, that is. And so those lag when markets are up meaningfully. It's also been a difficult last 3 years for venture capital and growth equity styles investing as they digested kind of fairly full valuations that you saw in late 2021 and 2022. Yes?
Robert, are these numbers public or is it just the people in this room who see these numbers?
These would be public. These numbers would also, we publish an annual report for 630 numbers. We share these with a few databases. Other than in this meeting, I don't know how these numbers would be public otherwise.
The follow-on is, can these numbers be compared with Harvard, Yale, Princeton, Duke, how do they compare with your counterparts?
Yes, 1231 numbers typically can't be easily compared. You compare 630 numbers. For 630, 24, we were third quartile for one, I think in 3 years, and then first or second quartile for 5, 10, and 20 years.
So every year, we benchmark where we are relative.
Oh, yes. We look at this every December with our board, and over the long term, we have been first or second quartile versus all of our peers. We have there's a 30 group of $5 billion and above endowments that we compare ourselves to.
Is that something you can put on the table and we can see what the other?
Oh, sure. Yeah.
Please do.
Yeah.
To that end, so I think it's much more relevant to compare it to people who have a similar mix of liquid and illiquid, because the performance is always going to be skewed if you have more liquid, right, up or down. So it would be helpful if you do that to show the comparison of alternatives, Yale at 95% illiquid, or, that sort of thing. So we're what, 60-40, or
Sorry.
what are we, like 60-40?
In terms of alternatives, it kind of depends on how you define alternatives, but think of it as, 65-35.
Right. So I think it would be helpful to compare that, because you could look falsely bad compared to those numbers, or falsely good.
Yeah, no, that's a good point. The last 3 years, the best performing endowments have been those with a lot of liquid strategies and very little privates. And that's been the opposite of the case over 5+ years. We tend to be kind of middle of the pack with respect to risk, illiquidity risk. We're not trying to kind of outflank our peers on those measures. We're trying to beat our peers through just day-to-day execution, whether that's manager selection or other ways. And we've done a good job of that over time. You can also see we've met all of our objectives over 5, 10, and 20 years, generating returns in excess of our passive policy, as well as generating returns that are sufficient to maintain the purchasing power of the endowment.
Isn't it true that the marks from the privates are pretty conservative, though, when they come out to you? So they're, they don't give you excessive marks. They try to keep it as conservative, so until they exit, your return, you don't really know what your returns are.
I think that's true in probably 8 out of 10 years. I think the marks that we probably had at the beginning of 2022 for venture growth turns out to have been high, because then you had a NASDAQ fall apart in 2022, and some of the valuations struck, as you know, in 2021 ended up not being conservative. But by and large, when we exit portfolio companies across our private strategies, Paul, to your point, you tend to see a valuation markup. That has also been a bit of a headwind to the last 3 years, because there just hasn't been many exits across our private strategies. Interest rate volatility has made it hard to sell leveraged buyout businesses, real estate businesses. Commodity price volatility has been a bit of a headwind as well to exiting resource positions and venture capital and growth. They do rely on IPOs, and IPO activity is very, very low right now.
They're also slow to drop the marks too. The last time they went down, they were slow to drop. So I think it works both ways.
It does. I do think in general, I think you'd want to be a buyer of mature privates than a seller for the reasons I just mentioned. A little more specificity here. You can see over 5 years, our equity-oriented strategies generating 11.7 versus 10.6. Really all strategies performing the way you'd like, other than liquid equities. Even over 5 years, it's been a difficult backdrop for our style of liquid equity investing, and here I'm specifically referring to public and long short. If you compare 8.3 to 10.6, that's not sufficient. Over that 5-year period, we've been disproportionately, as I said, invested in small cap equities, emerging market equities, really with an underweight towards North American mega cap companies, and that has been a headwind to performance. We've recently moved on from some relationships within public equity, added some passive exposure. You're seeing kind of good results for that, at least in the short term. So we're kind of think we're making promising changes there. Within long short, Adrian Clow we hired 2.5 years ago. She's doing a very good job. Any short-term period, long short probably isn't best benchmarked against the MSCI ACWI because we tend to invest a little bit more in biotech, for example, than you'd see in the ACWI, and biotech is kind of having a difficult year, but I think it's very promising managers and companies within that I'm excited about. Diversifiers generally doing their job over 5 years as well. I think it's an exciting backdrop for investing, in my opinion. Volatility creates opportunities for us. Lack of distributions from private strategies creates capacity for us because many of our peers, they might have 55+% in privates. We're about 45%, so we can play a little bit more on our front foot when it comes to getting capacity with our high conviction relationships. We've recently done that in multiple buyout managers, multiple growth managers, and so I think it's a nice backdrop for us. I mentioned biotech. We've added 2 new funds and relationships there. I've been building out our absolute return strategy, which you saw on the prior slide is generating north of a 7.5% return with no exposure to any traditional kind of risk factor. So I think the portfolio and the team is operating at a very high level, and I'm excited to add someone to the team as well. No major changes envisioned here across our asset allocation. You can see the blue wedges here align with that 75% equity-oriented policy weight. The orange aligns with that 25% to fixed income. That 25% to fixed income is meant to be diversifying. You want protection in deflationary environments, you want protection in inflationary environments, and we accomplish that through not only fixed income and cash, but also credit and absolute return strategies. We would like to continue to grow buyout. You wouldn't see that called out explicitly here, but it'd be in kind of one of the lighter blue private equity wedges. It is about 5% of the portfolio today. We'd like it to grow to 8 to 10%. Otherwise, I wouldn't expect any major changes here. Yeah.
Robert, refresh me, do we make direct investments or is everything through a fund manager?
I'd say 90% is through fund managers. We do invest directly in fixed income, and we will have overlay positions, either long positions within passive equities or short to tamp down risk of the portfolio that are also direct. But we co-invest actively with our managers, but I don't consider those direct investments. Those are when a manager comes with a high conviction idea and gives us capacity to invest in it alongside them.
Sorry, can I ask a question on your return? So you said 7.75 is sort of the target return. So that's
Yes.
a nominal, not a real, right?
Correct.
Okay. So then do you ever come back, and that's with acceptable risk. So how do you determine what's acceptable risk? Is that something you guys do or UVA does, or how does that?
We work with JJ and Augie to annually reassess the risk tolerance of the university. We look at kind of the diversification of its revenue streams, how it's acted in stressful market situations, and UVA has always acted very rationally. We do look at how our peers would allocate risk as well, because we do have kind of similar constraints and obviously similar models of operating. So we think that 75-25 is a good balance of risks. It gives you a very good chance of maintaining the purchasing power of the endowment with known and relatively little risk of short-term volatility significantly impeding the operations of the university.
Going forward, what do you project? What are you assuming for inflation, say over the next 5-10 years, and what are you projecting? 7.75? Or do you think we're gonna be below that, above that?
We project. We really kind of use the market to impute what it is projecting for higher education price inflation. I think this year it's 2.6% per year going forward for the next 7 to 10 years. That's been about what it's been. And so, yes, and we think we kind of array that against what we think our policy will generate, which I expect will be about 5.75%. We think equities will return 6% for the next 7 to 10 years in nominal terms, and that fixed income will generate 4.5% or so. 75-25 for that.
You
You
think
get,
we'll be below the 775?
we think the policy will.
Yeah.
We have historically added about 200 basis points of value in excess of the policy, and that's what we need to continue to do.
Robert, do you have what's your target volatility?
We don't target a volatility. It really kind of is an outgrowth of the way that we invest in the policy, and it's about 13%.
Okay.
Yeah.
Thank you.
I had a question. This is sort of a policy question for the board, I guess, and I just love some feedback from JJ and the president maybe and Robert. Obviously, the endowment is the lifeblood of the whole university. And so this is critical stuff. And I know we're very pleased with how UVMCO's performed over a long period of time. And the structure was set up very deliberately to be independent. However, I know we have a governance role with UVMCO with our board appointments that we make. I think I have that right.
That's correct.
And, you know, when I listened to the report, even as a member of the finance committee, you know, it's confusing to me a little bit. The jargon, the financial nomenclature. I don't know. I mean, if you're not an investment professional, it can be a little hard to track. So one thing I think maybe we could think about as a board, or maybe as a topic at one of our meetings, is just like, for example, the current board has no members of the Board of Visitors on it. We have Jim Murray, who we all have great confidence in and is a former member of the board, and I guess you're on there. We have great confidence. But like, that's something that's, you know, I think it's important for the board to feel like we're super close to some of these great questions that have been asked. I think the answers are good. And we see Robert twice a year, is that right?
That's right.
That's good, but this is so critical to our long-term future that, so for example, you know, how does the board turn over? How do we as the board exercise our governance right to put board members on there? What are the qualifications of someone that are useful to you, Robert, in setting policy for UVA? I know these aren't questions we're going to answer today, but I just think it makes, when I reflect on how critical this is to the long-term success of the university and the relative lack of understanding that I think your garden variety board member has about this stuff, just because it's by its nature technical and complicated. I think we gotta make sure we're clear-eyed about what we're doing to make sure we know what's happening, that we're getting good feedback about it. I mean, and I also be very interested to know, maybe just a sentence or two from the president and you. Do you guys feel like you're close enough to it and what's happening with you know, the university's money?
Yeah, so why
is
don't
that a
I
helpful
start?
question?
Yeah, no. Great color and commentary. So first and foremost, utmost confidence in UVMCO.
Right.
And the people that serve on the board of directors, for which we do not pay them, are top in class, right? So you think about somebody like a Ted Weschler or
That's
Tom
great.
Baltimore, right? So
That's the
who-
kind of information I'm interested in hearing, yeah.
Right, so people who are extremely accomplished in this space, who then give back time and tender for the long-term health of UVA. So I think that's point one. Point two, what I would say is there is a process by which there is board selection. The decisions is 3 of the appointees on the current board of directors are to represent the Board of Visitors. So, and there is a whole process that is, we have a whole governance committee.
And right now that's you, George Martin, and Jim Murray, is that right?
No, it's,
Or-
I serve at the president's request.
Okay.
So it's Tim O'Hare,
Okay.
and it's,
So we appointed Tim O'Hare, or?
Yes.
Yes.
Y'all did?
Yeah.
Okay.
yeah,
Okay.
and George Martin,
Okay.
again, former rector, and Jim Murray, former rector. So again, people with extreme both experience, understanding the Board of Visitors, the fiduciary responsibility,
Yep.
the underlying role.
That's 4 we have?
Right.
Okay.
Yes.
And then I guess I would say, happy to take it offline. I think someone like a Jim Murray.
and don't interpret anything I'm saying as any kind of criticism, just as someone who hasn't been on the board that long.
Yeah.
And I know how important this is. I'd like to deepen my understanding and understand better the governance relationship between the Board of Visitors and UVMCO, because it's the bank, you know?
Yeah.
So anyway, thank you. That was very helpful.
Okay, great.
Yeah, but going back to our mission, and we do want to, that's part of the non-return part of the mission, to be the best potential financial partner. So if there's anything we can ever clarify, we will. Robert and I connect occasionally. David and I connected. So happy to do that.
Thank you.
Did you have anything?
The only thing I would add, Doug, I know exactly what you mean. When I first started, I couldn't follow any of this. I now know enough to at least be able to understand the trade-offs, which is useful. And so I think if anyone wants more information to understand the basic trade-offs, I think that would be a good thing. What I will say, echoing JJ, is it's an incredibly impressive group. And they have never failed to answer a question that I had in a way that made me feel like, I'm glad you're running this and not me.
Well, that's great. Thank you.
I will close very quickly here. I was alluding to this earlier, over 20 years, impressive passive policy returns, but ours have been quite a bit more impressive, and you need that 200 basis points of outperformance per year to achieve that. And Doug, to your question, Robert, to yours on risk management, we really think of it in market risk, liquidity risk, manager risk. This too, we will focus on our board meeting next year as we kind of finalize next year's investment policy statement. Currently, versus policy running a little bit in excess of equity risk, here referred to as beta. That's just sensitivity to market risk. So if the market were up 10%, you'd expect the policy to be up 7.5% and our portfolio to be up 7.9%, just using that one number. Drawdown risk is kind of a negative 22% in both cases, and that's in a very extremely bad situation. Liquidity risk, we're really across the board in excess of our policy requirements. And then we do limit ourselves to 7.5% with one single relationship with the manager, and right now it's 4.8%. So with that, I will close unless there are any additional questions.
Other questions for Robert? Thanks very much for being with us again. We appreciate it, Robert.
Thanks.
Okay, I'm going to round up.
You got 13 minutes.
Okay, I'm going to move expeditiously. All the slides were provided in advance. What I wanted to do is just set some institutional context here about sort of the dynamic and fluid macroeconomic picture we find ourselves in. But always important to ground ourselves in why are we here and what's important about UVA. So really quickly on the institutional context, as you know, we attract and retain immensely talented faculty, staff, and students, and offer like a world-class education that's recognized globally. And here are just some of the numbers. The second thing I would just say here is we're a workforce now of 32,000 strong and 24,000 students. We will spend some time in audit today, I think, talking a little bit about sort of the recent EOs and some of the work around research, so I'm not going to belabor that. I think one of the other things that was really important to underscore here is that we sit in very rarefied air. And so it's really important to think long and hard about how we continue to lead and govern this institution. We're only one of 4 publics left with the coveted AAA bond rating. And as we've outlined for you in previous meetings, the importance of that, both in terms of our ability to access capital, but it's due to our strong financial management, our robust endowment, which you just heard from Robert on, and our strong fiscal management. Next, what I wanted to just show you here is that there is a declining population of AAA rated institutions as well. And we don't take this for granted. The implications of decreasing AAA rated institution is the pool is becoming increasingly smaller and our standing becomes increasingly significant. So people look to us as to how are we good financial stewards of this great institution. So how we manage through challenging economic times will be critically important. And you can see, and happy to take it offline, there have been some schools recently downgraded. from AAA. And happy to explain why. But again, I would just underscore everything we do. We think about the great people who built this institution before us and our role moving forward to make sure that we do sound financial management for the long term of use.
JJ, really quickly,
Yes.
would you give us a couple reasons about why they have been downgraded?
Yeah, so a couple of issues is just the slimmer liquidity margins, issues around disruptions between board and management. So again, there are both quantitative and qualitative factors that go into why institutions, they heavily focus in on the quantitative though. So the most recently was University of Washington downgrade. And again, happy to send all this. We get it every month. We're very, very focused on sort of how we as lead and how we manage through sort of turbulent economic times. Yes.
So am I reading the slide right? There are only 4 public universities that are AAA
Yes.
by all 3. How many privates are in there? Do you know?
5. Prior slide. 1, 2, 3, 4, 5, 6, 7. 7.
And I mean, obviously this affects the price of capital. If you're rated by 2 but not 3, that has an impact.
Yes, marginally. Yeah. Okay.
Sorry,
Yeah.
if we're an agency of the state, is there any sort of implied guarantee from Virginia to these bondholders?
No implied, but the flip is important, which is the UVA's AAA rated is accretive to the Commonwealth's bond rating. And the Commonwealth, as the state of Virginia, is also a AAA rated institution. So which is why Secretary of Finance often regularly calls us and cares deeply about how are we performing overall financially. Okay?
You're not going to have time to hit every one of these slides,
Okay, I'm
so I
going.
would advise you to pick the ones you
Okay,
think
I'm
are
good.
most important.
Okay, good. Okay, thank you. So I just want to say
I mean,
here.
everyone's already read them. So
We've already read them. So a couple of things I just want to focus in. The budget process is continual in nature. Recently, in working in coordination with senior leadership and President Jim Ryan, we did issue requests for budget reductions and revenue reductions across the institution. So that information is now coming into our office. We see more right now economic headwinds than tailwinds. And what I mean by that, I will go right to a slide which I think can underscore this. I'm going to cut through all this. So we're going to talk about federal policy issues and audit, so I'm not going to belabor it here, but just one of the key drivers for us is obviously headwinds with respect to research programs, obviously implications of Pell and financial aid on our overall Access UVA program. You've seen potential tax changes for higher education that we're working with in conjunction with UVIMCO, immigration, international travel, questions around sort of tightening up of Medicare, Medicaid 340B. So more headwinds than tailwinds. But let me stop here because I think what we tried to do on this one slide is just illustrate graphically sort of major issues that we're grappling with. And again, happy to take this offline, love to have conversation. This is not me talking at you, but rather we're in this one together. And specifically, we talked about the compensation increases, large increases in base costs. NCAA policy changes, we've talked about extensively about what the importance is to support athletics. That adds dollars to the bottom line that we must find for this coming fiscal year. Federal policy changes, you name it. We've talked about everything from research cuts to freezes to a potential government shutdown coming mid-March. So all of that is in the mind meld as we analyze how do we build the 26 budget. Commonwealth changes we laid out for you earlier today. Again, some great news on the Seville BioHub Accelerator plus the performing arts. Challenges are not a lot of new operating money and pretty big cost centers coming in. And then the economic environment. So, broader sort of how are we thinking about sort of how is this impacting our employees, inflation, cost of services, healthcare costs are going up. Underneath it are sort of all the levers we're pulling, and we're not done pulling levers. As we assess the sort of macroeconomic climate, we think about what are the additional tools in our tool belt, either raising revenues, cutting costs, driving down mandated costs. So there's a whole section in this PowerPoint presentation to talk a lot about sort of what are we doing to be more efficient and effective. You'll see some of it in audit today and some of it we think, obviously at a $5.8 billion budget, I think Doug, you said it best. we have to kind of step back and say, are there things that we can do in a more central format and cut costs? So have a whole list of those initiatives under consideration. Some are easier than others, some are bigger dollars than others, and some simply take time. But all those,
I'm sorry.
can I finish real quick?
Yes,
Okay.
please.
And then, obviously,
I know we're running out of time.
driving down mandatory costs. So where do we have costs? Where can we renegotiate? Budget cuts, as we outlined for you, we have issued budget cutting scenarios across the institution and revenue reductions. Key focal point for us is hiring and how do we plan for the future. As you know, 2/3 of every cent is people, right? So if we really have to start to tighten the screws down like we had to do in COVID, we'll have to start to look at things like implementing hiring. Do we slow it down? Some schools are already doing it. Some units have already started it, but do we take a more comprehensive look to managing and bending the employment cost curve? And then obviously all behind that is timing of priorities. What needs to move forward? What could be slowed down? Yes.
Well, I know we're near the end and we don't have a whole lot of time for discussion, but just speaking as a finance committee member, I would like to have what I think of as more like a working session where we have more visibility into the cost structure of the university. And not to try to figure out how many pencils we need in the sociology department, but just to see from an org chart perspective. I think there's a feeling among, I know I feel this, and I think there are others who do too, that there are opportunities to reduce overhead expense, to find efficiencies. We've talked about some ideas I have, and I'm sure it's probably a lousy list compared to good ideas that other people would have. And then, another major factor that is highly related to that is the tuition question.
Right.
You hear it every day that the cost is way up, and I know we compare ourselves to other people and we compare favorably, but for me that's not the end of the analysis, it's the beginning. Like what could we do for those students and the families? Could we keep tuition flat or lower it at some point? And I think the only way to really get at that question like that the information we tend to get at board meetings is very high level and conceptual. And I know there's a lot of work going on behind the scenes. I just would like to have a better feel and be closer to some of the actual numbers. And so I don't know if there's a mechanism we can do for that, but I think in order to be comfortable, to speak for myself, to be comfortable approving any budget, I would like to see more detail behind what we have here.
Oh, yeah, so I think everybody, you've heard people talk about big cuts, and I've also heard the other side, like, hey, well, justify it. You can't just throw numbers out. And I think along Doug's line is, I think we're all happy to try to help justify it, but we really have to have access. And we're also happy to, those who do think big cuts should be made, coordinate and limit our line of questioning through a single sort of voice or voices so that we don't flood you with requests. But I do think people want to see more transparency.
So, yeah, just to build on, we talk about building a budget. I just think that needs to be a lot more collaborative. We talk about it in the December meeting, but I haven't really seen any difference this year versus last year in terms of building the budget, and we're just a few months away. What I don't want to happen is to get to June and, there's a train wreck. I think we're all trying to avoid that. So we want to make sure, I think the administration understand, we are very serious about freezing tuition. I would like to see that, if possible. I would like to see cuts in the administration, but I hesitate to say how much because it's hard getting numbers. It's hard to make that analysis without a lot of data. But I would like to see some cuts in the administration as well. We should really try to meet before April 30th and come to some consensus on these issues. We should not wait until June.
Let's triangulate and we can pick a time to have a finance committee meeting in advance of the next meeting with plenty of time to think through the issues.
Great. Happy to.
Great. Thank you.
But I do think a majority of this board is going to expect tuition being flat and preferably reduced.
Without the oversight of the university role.
How would we know that?
Some conversations among different board members.
Okay, we can discuss all these things in our next meeting. So JJ, I think we need to be more granular with the information. People have a lot of views. We want to have a meeting and talk about it. It sounds like that you're amenable to that.
Absolutely.
Yeah, and Mr. Penny, do you have a comment?
Very quickly, thank you. Without the oversight role, of course, it would be terrific if the faculty senate in some capacity could either participate directly in that or have our own consults. I think our finance committee and our board would be very interested in having the same level of insight. Thanks.
All right, I think you've gotten your direction.
Thank you.
Very
Well
good.
scheduled.
We're adjourned.
Give the College of Lies 2 or 3 minutes to.
I have no idea.